After the most recent Fed meeting earlier this month, where rates were held steady and 17 of 19 Fed policymakers said that they saw rates ending up lower by the end of next year, a lot of investors are starting to feel significantly more optimistic heading into 2024. And while we still don't know if or when these cuts would happen, a falling Fed funds rate could have material impacts on many parts of the commercial real estate industry, including property valuations, transaction activity, and the real estate job market as a whole. So with rate cuts now potentially on the table for 2024, in this video, we'll cover some of the biggest implications of falling interest rates on the commercial real estate industry and what this might mean for you if you're an investor or if you're trying to start your career in this business in the new year. So the first thing worth mentioning in this video is that even if we do see multiple interest rate cuts next year, this will most likely end up being too little too late to prevent most distress from happening within commercial real estate. For investors that loaded up on new acquisitions throughout 2021 and into early 2022 using short-term floating rate debt, these deals are still very likely to run into some major problems at loan maturity despite rates potentially easing up. The 1-month secured overnight financing rate, or SOFR for short, is often the index rate used to determine the interest rate on a floating rate loan in the US. And if we look at the most recent forward curves from Chatham Financial, which are often used by real estate firms to make projections about interest rates in the future, SOFR is predicted to drop to just over 3.2% by the end of 2025, which is a significant decrease from the 5.3% rate we're seeing in December. However, even though this drop looks pretty steep when compared to recent rates, if we take a look back at historical data, a 3.2% 1-month SOFR is still massively different than what we saw in 2021 and early 2022 when SOFR hovered at or below just 10 basis points throughout this time. And when pricing these loans at index rates this low, interest rate spreads on this debt were often in the 300 to 400 basis point range, meaning that what may have started out as just a 3% or 4% all-in interest rate is now up above 8% on these loans and would still only get down to about 6.2% at the minimum by the end of 2025. And with a looming wall of loan maturities coming up over the next 2 years, a lot of investors simply just can't wait that long. And even if they could, these cuts likely won't be enough to avoid capital calls to equity investors, or in some cases, even handing the keys back to the lender altogether. This is especially true for deals in the multifamily and industrial sectors that commonly saw acquisitions with cap rates in the 3% to 4% range in 2021 and 2022, which also relied on 3 to 4% interest rates just to make these deals pencil. For example, on a $10 million acquisition bought at a 4% cap rate in 2021, if a borrower used floating rate debt priced at 350 basis points over SOFR at a 70% LTV ratio, even if SOFR were to drop back down to 3.2% by the end of 2024 to be even more optimistic, that all-in interest rate is still going to be 6.7% even after those cuts have all played out. And assuming that this is an interest-only loan, annual debt service would come out to $469,000 at this 6.7% rate, meaning that this investor would have needed to see more than a 17% increase in NOI since the initial acquisition just to break even on a monthly basis, which hasn't necessarily been easy to do with rising insurance costs, increases in labor and material costs, and even rent reductions in many markets across the country. And even if we were to assume that this investor was able to increase NOI to that break-even point, at the end of the loan term, if that investor wanted to hold on to the property and refinance into a long-term fixed rate loan, 2025 projections for the 10-year US Treasury, which is the index rate that's commonly used in the US to price 10-year fixed rate loans, are currently coming in at about 3.9%, and assuming just a 160 basis point spread above that index and a minimum required DSCR of 1.25x, those new loan proceeds would come in at just over $5.5 million, meaning that the borrower is going to need to come up with almost $1.5 million of additional capital just to pay off their debt, which represents almost 50% of their original $3 million investment. All of this is to say that even though it's looking like rate cuts could very well happen next year, these most likely won't be enough to save borrowers that aggressively levered up properties using floating rate debt over the last few years. Now, if interest rates fall in 2024, another thing that's very likely to happen that's somewhat related to the impending distress that we just talked about is that transaction activity is very likely to pick up, and when it does, it's very likely to pick up quickly. Right now, there's still a really big bid-ask spread between buyers and sellers of commercial real estate, but the vast majority of this is being fueled by higher borrowing costs, which aren't allowing buyers to get to the price points that sellers are looking for, which is ultimately the biggest thing that's preventing deals from getting done. But if we do end up seeing multiple rate cuts in 2024, like many investors are predicting right now, a reduction in borrowing costs, even if this is only a small drop when compared to how much rates have increased since the spring of 2022, could lead to materially higher offer prices from buyers in the market. Just as we've seen happen in real time over the last 18 months, cap rate movement is heavily tied to movement in interest rates, and if cap rates were to drop by even just 100 basis points, assuming a property was valued at a 6% cap rate at the beginning of the year and a 5% cap rate at the end of the year, this would result in a 20% increase in property valuations and much different offer prices for deals in the market. According to Preqin data from earlier this year, there was also over $284 billion of dry powder held by real estate managers at the end of 2022, and with all this capital on the sidelines, that's essentially just waiting to be deployed as soon as pricing appears to have bottomed out, we could very quickly go back to a market with big buyer pools and a competitive bidding process, which will also drive values up as demand increases. And when valuations increase and sellers are once again willing to sell, this should translate into an increase in transaction-related revenue for all types of commercial real estate firms. And when this happens, companies that have seen huge drops in production over the last few years and have had to pause hiring or even lay off some of their workforce will now very likely need to increase their headcount, or at the very least replace the talent they had to let go over the last 18 months, which could lead to a significant number of job opportunities in all kinds of transaction-oriented roles. And at the same time that this could be happening, over 12,000 Americans per day will turn 65 years old in 2024, and for an industry like commercial real estate, with almost 50% of the business being made up of employees that were 55 and older as of 2019, this means that there also may be a lot of movement internally within companies to fill these senior positions as senior executives retire, which will also create opportunities at the analyst and associate levels. Now, obviously, we can't know for sure exactly what's going to happen next year, and this could all change if we start to see inflation tick back up again, but if interest rates do fall in 2024, these are the big things that I see happening in commercial real estate next year, and if you want to make sure that you are ready for job openings that might come up as a result of these changes, or to just take advantage of distress as loan maturities start to impact the market, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on interest rates or current market events, make sure to hit the like button to let me know, and let me know in the comments what your predictions are for commercial real estate in 2024. As always, thanks so much for watching, guys. I hope you and your families have a happy new year. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in 2024.